Hello again, investing putts with you. Um, TLT is a popular ETF that focuses on long-dated treasuries, typically 20 plus years to maturity. TLT has been rising steadily since September 2018, when many people thought that the business cycle had peaked and a recession was imminent. You can see that when people started getting defensive from COVID around January of 2020, the price of TLT really spiked, and it peaked at about $170 in August of 2021 when interest rates bottomed out. Since then, the TLT has dropped a whopping 20% and very fast, bottoming out around $135. So a lot of the financial media that I follow is starting to call a bottom in treasuries. Even if you think the reflation trade is still on and you think that interest rates are going up, large funds in the short to medium term are still going to have to rebalance after the sudden drop in treasuries. So there's going to be buying pressure in treasuries. Is this a bottom? Well, this week's, the past week or so's price action on TLT is the biggest increase that we've seen since August. So I'm going long, or at least I'm going to trade the poor man's covered call. So in my $25,000 account, I don't want to tie up $14,000 in TLT shares. So I'm going to trade the poor man's covered call strategy by first buying a leap option dated to January of 2022, so about 9 months in the future. I went for the 125 strike, which had a delta of 0.75 and was about $15.50 when I bought it. So if we look at the covered calls, at the April 1 expiration, 30 delta calls that are 9 days to expiration, the premiums are not great for covered call selling, only about 0.4% of the share price. In the stocks that I trade the wheel on, I'm typically shooting for at least 1% of the share price in premium per week. But since my cost basis with the poor man's covered call is only $15.50, the effective premium from selling these calls is actually 3.4% of my cash basis. So as long as TLT can stay above the strike of my leap, which is $125, I can keep selling these calls. To give you a sense of TLT at the leap strike of $125, I've plotted the 125 line against the 5-year price in TLT. 125 would be a 2-year low, and it would be down an additional 10% from today's prices. So it would be a total 30% drop from the August peak, which is not impossible, but it would be pretty severe. So I may not have called the bottom exactly, but unless we're truly headed for a big inflation, I think that 125 is a pretty safe strike for a TLT leap. We'll find out. It's my first time I've traded the poor man's covered call. I think the price of this leap is pretty competitive. Really, only about 12% of the actual share price. I've looked it up, leaps in other stocks, and it's pretty cheap when you can get a 75 delta covered call 9 months out for 10%, 12% of the share price. So I think I'm in good shape, but we'll find out. Thanks.